Welcome learners. I am R. Nalini, one of the facilitator for the course on financial accounting.
Any economic transaction or event of a business which can be expressed in monetary terms should be recorded. Traditionally, accounting is a method of collecting, recording, classifying, summarizing and presenting and interpreting financial data of an economic activity. The series of business transactions occurs during the accounting period and its recording is referred to an accounting process. An accounting process is a complete sequence of accounting procedures which are repeated in the same order during each accounting period. Journal is a first book of original entry in which all transactions are recorded event-wise and date-wise and presents a historical record of all monetary transactions. Today, I am going to present a lecture on what is the meaning of journalization, what are the characteristics of journal, what are the advantages and limitations of journal, what is the procedure followed for preparing the journal, what are the terms relating to the journalization, then rules for journalizing, then determination of the nature of transaction, whether credit or cash. What are the terms related to journalization? First one is source documents. These documents always help in recording the transaction in the books of account. They are cash memo, invoice, pay-in slip, check, debit and credit note. So, source documents in the sense, these documents always help in recording the transactions in the books of accounts. The documents like cash memo, invoice, receipt, pay-in slip, check, debit and credit note. First one is cash memo. The seller issue it to the buyer when goods are sold on cash basis. The seller issue it to the buyer when goods are sold on cash basis. So that is the meaning of cash memo. Cash memo, it is a printed document which contains information regarding the name of the seller, date, description of the goods, description of the goods sold, including quantity and rate at which goods were sold. It provides details about cash transaction, which become the basis for recording these transactions. So next one is invoice. Invoice is a document which prepared when goods are sold or purchased on credit. A sales invoice is prepared to record credit sales. It contains information such as name of the party to whom goods are sold, total amount of sales and description of goods sold. It is prepared in triplicate by the seller. The original copy is sent to the buyer. The second copy is sent to the account section and sales department for future retains third copy. That is, invoice is one of the document. This document is prepared when goods are sold or purchased on credit. A sale invoice is prepared to record credit sales. It contains information like name of the party to whom goods are sold, total amount of sales or description of the goods sold. This This is prepared in triplicate by the seller. The original copy is sent to the buyer, the second copy is sent to the account section, and third copy is retained by the sales department. Next one is check. It is a written document drawn upon a specified banker and payable on demand. The name of the party to whom the payment is to be made should be written clearly after the words paid to. The details of the payment through the check are also recorded on the counterfoil, which forms the source document regarding payments. So, check is a written document drawn upon a specified banker and payable on demand. The name of the party to whom the check payment is to be made should be written clearly after the name words paid to. The details of the payment through the check are also recorded on the counterfoil, which forms the source document regarding payments. The next one is receipt. It is issued by the firm who receives cash from customers. It is prepared in duplicate. The original copy is given to a person making payment and duplicate is kept as record for future. Receipt contains date of issue, amount received, name of the paying party. Next one is nature of payment. The next document is pay-in slip. This is a standard form, pay-in slip. This is a standard form issued by the banks for depositing cash or check in the bank account. It consists of two parts. The cashier returns one part to the depositor after his signature, while the other part is kept by the bank. Then debit and credit note. When goods are returned to the supplier or an additional amount is recoverable from the customer, then these notes are prepared. The document becomes debit note for the party from whom money is recoverable, and it becomes the credit note for the other party who is to recover the amount. Thus, a proper credit note should be sent in case of customer returns the goods. So, that is also one of the document prepared for debit and credit note.
Today, I am going to present a lecture on what is the meaning of journalization, what are the characteristics of journal, what are the advantages and limitations of journal, what is the procedure followed for preparing the journal, what are the terms relating to the journalization, then rules for journalizing, then determination of the nature of transaction, whether credit or cash. Always help in recording the transaction in the books of account. They are cash memo, invoice, pay-in slip, check, debit and credit note. So, source documents in the sense, these documents always help in recording the transactions in the books of accounts. The documents like cash memo, invoice, receipt, pay-in slip, check, debit and credit note. First one is cash memo. The seller issue it to the buyer when goods are sold on cash basis. The seller issue it to the buyer when goods are sold on cash basis. So that is the meaning of cash memo. Cash memo, it is a printed document which contains information regarding the name of the seller, date, description of the goods, description of the goods sold, including quantity and rate at which goods were sold. It provides details about cash transaction, which become the basis for recording these transactions. So next one is invoice. Invoice is a document which prepared when goods are sold or purchased on credit. A sales invoice is prepared to record credit sales. It contains information such as name of the party, to whom goods are sold, total amount of sales, and description of goods sold. It is prepared in triplicate by the seller. The original copy is sent to the buyer. The second copy is sent to the account section, and sales department for future retains third copy. That is, invoice is one of the document. This document is prepared when goods are sold or purchased on credit. A sale invoice is prepared to record credit sales. It contains information like name of the party, to whom goods are sold, total amount of sales, or description of the goods sold. This is prepared in triplicate by the seller. The original copy is sent to the buyer. The second copy is sent to the account section, and third copy is retained by the sales department. Next one is check. It is a return document drawn upon a specified banker and payable on demand. The name of the party to whom the payment is to be made should be written clearly after the words paid to. The details of the payment through the check are also recorded on the counterfoil, which forms the source document regarding payments. So, check is a return document drawn upon a specified banker and payable on demand. The name of the party to whom the check payment is to be made should be written clearly after the words paid to. The details of the payment through the check are also recorded on the counterfoil, which forms the source document regarding payments. The next one is receipt. It is issued by the firm who receives cash from customers. It is prepared in duplicate. The original copy is given to a person making payment, and duplicate is kept as record for future. Receipt contains date of issue, amount received, surname of the paying party. Next one is nature of payment. The next document is pay-in slip. This is a standard form. Pay-in slip. This is a standard form issued by the banks for depositing cash or check in the bank account. It consists of two parts. The cashier returns one part to the depositor after his signature, while the other part is kept by the bank. Then debit and credit note. When goods are returned to the supplier or an additional amount is recoverable from the customer, then these notes are prepared. The document becomes debit note for the party from whom money is recoverable, and it becomes the credit note for the other party who is to recover the amount. Thus, a proper credit note should be sent in case of customer returns the goods. So, that is also one of the document prepared for debit and.
What are the characteristics of journal? Here, journal is a book of original entry. Journal means it's nothing but it is a book of original entry. Next one is it keeps a chronological record of the transactions, that is according to occurrence of the transactions. Third one is it helps the ledger, which is a principal book of accounts. Then journal shows a complete picture of each and every transaction. So, this is a nature of transaction on the basis of transactions with the help of narrations. Narration means it's nothing but it's the explanation of the transaction. It also known as day book. Then let us go to journalizing. Journalizing means it's nothing but it's a process of recording a transaction in journal is called journalizing. That is, the process of recording a transaction in a journal is called journalizing.
Now, we see steps in journalizing. The various steps to be followed in journalizing business transactions are: first step,
is ascertain what accounts are involved in a transaction. For example, salary paid. So in that salary paid, what are the accounts are involved here? Salary account and another one is cash account. So first we have to ascertain what accounts are involved in a transaction. Then next one is step 2. Ascertain what is the nature of accounts involved. Nature of accounts in the sense whether it is a personal account, real account and nominal account. Here for example salary paid, here there are two accounts involved here. One is salary account and another one is cash account. Here salary account is relating to nominal account. Cash account is relating to real account. That is the second step. Then third step is ascertain which rule of debit and credit is applicable for each of the accounts involved. After identification of the nature of accounts, the next one is we have to identify which is to be debited and which is to be credited. Okay. So what is the rule of debit and credit? Under this salary paid, here salary is a nominal account. What is the rule of nominal account? Debit all expenses and losses, credit all incomes and gains. So salary is one of the expenses. So that is to be debited. Cash is a real account. What is the rule of real account? Debit what comes in, credit what goes out. So here cash goes out of the business. So that is to be credited. That is the third step. So we have to apply the rule of debit or credit. Then fourth step is ascertain which account is to be debited and which account is to be credited. Here salary account is to be debited and cash account is to be credited. Then fifth step, record the date of transaction in the date column. So record the date of transaction in the date column. Then sixth step is write the name of the account to be debited very close to the left hand side along with the abbreviation DR on the same line against the name of the account in the particular column and the amount to be debited in the debit amount column against the name of the account. That is, write the name of the account which is to be debited. Write the name of the account which is to be debited in the sense here, for example, here salary is paid. Salary paid. Salary account is to be debited. Salary account is to be debited. So very close to the debit. Here name of the account is to be debited. So here salary account. Salary account debited. Salary account very close to the left hand side, debited DR. So that is along with the abbreviation DR. Okay. Here name of the first one, name of the account is to be debited. Name of the account is to be debited, which is salary account, for example salary paid. So salary account debited. The same line we have to write debit in the particular column, in the account particular column, and the amount to be debited in the debit amount column. So we have to write the amount in the debit amount column against the name of the account. For example, salary paid rupees 500. So in that amount column we have to write rupees 500. Debit amount column you have to write rupees 500. Okay, so there are several steps in journalizing. First step is what accounts are involved in a transaction. What accounts are involved in a transaction? For example, salary, salary pay, salary paid rupees 100, just for example. Okay, here what are the accounts involved? Here one is salary account and another one is cash account. Here next you have to identify the nature of accounts. So salary account is a nominal account. Salary account is a nominal account. Cash account is a real account. Cash account is relating to real account. Cash account is a real account. Then next you have to apply the rule of debit and credit. So here salary account debited, for example salary account, here salary account debited, salary account debited, cash account credited. Next we have to identify, apply the rule. Okay, cash account credited. Then next one is record the date of the transaction. So date should be recorded under the date column. Date should be recorded in the date column. Then next one is write the name of the account to be debited very close to the left hand side along with the abbreviation DR. On the same line, again the name of the account in the particular column, and the amount to be debited in the debit amount column, again the name of the account. Then seventh step. Seventh step is write the name of the account to be credited. Write the name of the account to be credited in the next line preceded by the word to. Add a few spaces towards right in the particular column. In the particular column, and the amount to be credited in the credit amount column. Okay, which account is to be credited? Cash account is to be credited. So cash account is to be credited. So we have to add to cash. Cash account is to be credited. So we have to add to cash. So to add to cash account in the particular column, and amount should be written in the credit amount column, rupees 500. Okay. Then next one is narration. Narration within the bracket. Narration means it's nothing but this is the explanation of the transaction. What is this transaction? Cash paid. So the narration is just you have to write cash paid. So the salary is paid. So the narration is the explanation of the transaction. So the transaction is salary paid. So salary paid. Salary paid, that is to be recorded in the bracket. Salary paid. Salary paid, which is written with the bracket. This is called narration. Narration means it's the explanation of the transaction, which is narration within brackets in the next line in the particular column. Okay, the next step is draw a line across the entire particular column to separate one journal entry from the other. That is the last step. So draw a line across the entire particular column to separate one journal entry from the other journal entry. Okay, do you understand? Okay, then.
Now we shall see what are the advantages of journal. A journal, there are so many advantages. The transactions are recorded in journal as and when they occur, so the chance of error is minimized. So the transactions are recorded in journal as and when they occur, So the chance of errors minimized. So when recording the transaction in the journal book, so this is a complete record. So to minimize the chance of errors. Then next advantages is it helps in preparation of ledger. Journal is the primary entry. After recording the transactions in the journal, then these transactions are posted to the ledger account. So journal helps in preparation of ledger account. Any transfer from one account to another account is made through journal. The entry recorded in journal are self-explanatory as it includes narration also. So in that journal, it record explanation of the transactions. So that is called narration. So that is also recorded in the journal. Then it can record any such information which cannot be entered in any other books of account. So which cannot be entered in any other books of account. So it can record all transactions. Then every transaction is recorded in chronological order, that is date-wise order. So the chance of manipulations are reduced. So all the transactions are recorded here. The transactions are recorded in day-to-day order. So to reduce the chance of manipulations. Then journal shows all information in respect of a transaction at one place. So it shows all information. So these transactions are shown on at one place. Then the closing balance of previous years of account related to assets and liabilities can be brought forward to the next year by pausing journal entry in journal. So simply, what are the main advantages of journal? First one is to reduce the chance of errors or to minimize. So chance of errors is minimized. The next point is journal helps in preparation of ledger account. Then third one is transfer. So any transfer from one account to another account is made through journal. Then self-explanatory. So the entry recorded in journal are self-explanatory. That means narration also recorded here. Narration in the sense explanation of the transaction was given here. Then books of account. That means it can record such transaction which cannot be entered in any other books of account. Then here all the transactions are recorded on the date wise. So to reduce the chance of manipulations. Then journal shows all information in respect of a transaction at one place. Then last advantages is assets. That is the closing balance of previous years of accounts which is related to assets and liabilities which is brought forward to the next year by pausing journal entry in journal. So these are the advantages of journal account. Now we shall see the limitations of journal. First point is limited use. The practical use of the journal is limited. In this, all transactions are not recorded, but only those transactions are recorded which are limited in numbers and which are not written in subsidiary books. Then more useful for small business. It is not useful for large scale organization because large scale organization have more number of transaction. If all the recorded in one account, then the size of the journal will become big and this will be difficult for one person to maintain. So subsidiary books which is used only for small scale organization and not large scale organization. Okay, because large scale organization they have there are more number of transactions. So if all are recorded in one journal, then the size of the journal will become big. So this is difficult for one person to maintain this ledger account. Then lack of business information. In journals, transactions are kept at one place. Therefore, business information can be received easily. If traders want information about the cash, bank, stock, creditors and debtors, income and expenses, then with the help of journal, such information cannot be provided. So that comes under lack of business information. So what are the limitations of journal? First one is limited use. Here all transactions that is not recorded in the case of large scale organization because the transactions are huge in number. So this is used only for small scale organization. Then second one is more useful for businessman. It is not useful for large scale organization because they have large number of transactions. If all the transactions are recorded in one journal, so that will become big. This is very difficult for maintaining the account by one person. Then lack of business information. In journals, transactions are kept at one place. Therefore, business information can't be received easily. If traders want information about the cash, bank, stock, creditors, debtors, any other information, then with the help of the journal, such information cannot be provided. Now, looking in the meaning of goods. Goods means things which are bought by trader for the purpose of resale at a profit. In other words, we can say that goods mean those goods in which a trader deals. For instance, books for a bookseller, furniture sold for a furniture dealer, etc. So goods account can be classified in the 4 parts. Again, goods means it's nothing but it is meant for things. That is goods. It is meant for things which are bought by the trader for the purpose of resale. So the goods, the trader, they can purchase the goods only for the purpose of resale at a profit. So at a profit. This is the meaning of goods. What is the classification of goods? First one is purchase account. When goods are purchased, then purchase account is debited instead of goods account. It records all the purchase of goods. So purchase account, it records all the purchase of goods. It records all the purchases. So it should be debited. Then second one is sales account. Here it records sale of the goods. When goods are sold, then sales account is credited instead of goods account. So sales account, second one is sales account. It records sale of goods. When goods are sold, then sales account is credited. Always sales account will be credited. Then next one is purchase return account. If goods purchased or returned, then it is called purchase return. This account is credited. So if goods purchased or returned to the supplier, so that is called purchase return. This account is credited. Then sales return account. If goods sold or returned, then it is called sales return account. This account is always debited. So if goods sold or returned, then it is called sales return account. This account is always debited. Then closing stock account. It is the value of stock remaining unsold. That is called closing stock. That is, the stock at the end of the period is called closing stock. It is the net balance of opening stock plus net purchases minus net sales. What is the meaning of net purchases? Purchase minus purchase return. That is called net purchases. Similarly, sales, total sales minus sales return is called net sales. So it is valued at cost or net realizable value or market value, whichever is less. So closing stock means it's nothing but the stock at the end of the year is called closing stock. This should be calculated by opening stock plus net purchases minus net sales. Is it clear? So these are the different classification of goods: purchase account, sales account, purchase return account, sales return account, and another one is closing stock account. So the goods account, which can be classified on the basis of, that is classified in 5 parts. Now let us see the determination of the nature of transactions, whether credit or cash. Whether a particular transaction is made for cash or credit in case of purchase and sale of goods, it should be determined. So first we have to determine whether this transaction is a cash transaction or credit transaction in case of purchase and sale of goods. A cash transaction is to be treated as, that is cash transaction it is to be treated as when the word cash. So if it is cash mentioned in that problem, that represents the cash transaction. But the credit transaction, in the sense when only the name of the person is given. So only the name of the person is given, that is called credit transaction. So credit transaction means when only the name of the person is given is called credit transaction. In the cash transaction, they can give a cash transaction. Then for example, here transaction is goods sold for rupees 15,000 in cash. Goods sold for rupees 15,000 in cash. Whether it is a cash transaction or credit transaction, here in cash. That should be clearly mentioned here. So this is a cash transaction. Then next one is goods sold for rupees 20,000 in cash to X. So goods sold for 20,000 in cash. So 20,000 cash sales in that cash column, because the cash, the word cash is given here. Next one is goods sold for rupees 35,000 to John. Here the name of the person was given here, so this is a credit transaction. Do you understand? So the cash, in cash which was given, that should be treated as cash transaction. Goods sold rupees goods sold for 35,000 to John, that should be credit transaction. So because the name of the person is given here. Okay, this is a way for recording the transaction. Before recording the transaction, you have to find out whether it is a credit transaction or cash transaction. Now we have discussed some of the accounting terms. First one is drawings. drawings. Drawings is nothing but the proprietor can withdraw their cash or goods for their personal use is called drawings. That is the assets in the form of cash or goods which are withdrawn from the business for his personal use is called drawings. It also referred to as withdrawal account. So automatically it reduces the total capital invested in the business by the proprietor. So it also referred to as withdrawal account. It reduces the total capital invested in the business by the proprietor. In the case of goods withdrawn by owner for his personal use, so automatically purchases are reduced here. So if the owner, they can withdraw their goods for personal use, the purchases are reduced. So the owner's capital is also adjusted here. In case of goods withdrawn, the valuation is done only at cost price. In case of goods withdrawn, the valuation is done only at. Now let us see how the journal entry passed for drawings of goods or cash. If the proprietor, they withdraw cash from his hand or bank account for his personal use, that is in case of cash withdrawn for personal use from in cash in hand or official bank account. So the journal entry passed here on the basis of British approach or traditional approach. Here journal entry is drawings account data to cash account or bank account. If the proprietor, they can withdraw cash for his personal use, the journal entry is drawings account data to cash account. If the proprietor withdraw cash from his bank account, here the journal entry is drawings account data to bank account. On the basis of American approach or modern approach, here debit the increase in drawings and credit the increase in asset. Okay, because the cash goes out of the business, so automatically the cash value decrease. So credit the decrease in asset. If drawings, debit the increase in drawings. So on the basis of American approach, drawings, that should be debit the increase in drawings. Cash, which should be credit the decrease in asset. In case of goods withdrawn for personal use, goods withdrawn for personal use from the business. So the journal entry is on the basis of British approach or traditional approach, drawings account data to stock or purchase account. Drawings account data to stock or purchase account, because the value of stock that should be reduced. So stock account will be credited or purchase account will be credited. On the basis of American approach or modern approach, here debit the increase in drawings, credit the decrease in asset. On the basis of modern approach or American approach, debit the increase in drawings, credit the decrease in asset. Is it clear? Okay. Let us see. Drawings is a temporary account which is cleared at the end of each accounting year and is not shown as a business expenses. A debit balance in drawings account is closed by transferring it to the capital account. It does not directly affect the profit and loss account in any way. So what is the journal entry for here? Drawings account data to cash or bank account. The accounting equation changes with every transaction that happens in a business. Similarly, withdrawals for personal use, the accounting equation is also changed. So what is the adjusting entry to show the decrease in capital? If the proprietor, they can withdraw cash, so automatically it decreases the assets. There is no change in liabilities. Cash also, that is the capital, is also decreased because the amount of drawings which is to be adjusted with the amount of capital. So automatically the value of capital will be decreased. If the proprietor, they can withdraw their goods for his personal use. Here the value of assets will be decreased. There is no change in liability. Here capital is also decreased. So there is an adjustment entry to show on the decrease in capital amount. Now let us see income tax paid. How the income tax paid, which is to be recorded in the journal books. Income tax is a tax on the income of the owner or proprietor or partner in case of sole proprietorship and partnership firm. It is a personal liability of a businessman. So the entry will be drawings account data to cash account. So income tax paid, the income tax is an income of the owner. Income tax, that is income of the owner or proprietor in case of sole proprietorship and partnership firm. So this is a personal liability of a businessman. So the journal entry for this transaction is drawing account data to cash account. Then interest on capital. Interest on capital is allowed on capital. The entry is interest on capital account data to capital account. So interest on capital is on expenses for the business. So it is to be debited. The capital account has been credited because the amount has become due to the proprietor. So interest on capital, interest is allowed on capital is called interest on capital. The journal entry for the interest on capital is interest on capital account data to capital account. Here transfer entry is profit and loss account data to interest on capital account. So interest on capital is one of the expenses for the business. So it is to be debited. The capital account has been credited because the amount has become due to the proprietor. Then next one is interest on drawings. Interest on drawings in the sense it is charged from the proprietor on the drawings made by him. That is called interest on drawings. So the journal entry for this transaction is here. The journal entry for this transaction is the capital account data to interest on drawings account. Capital account data to interest on drawings account. That is interest on drawings which is charged from the proprietor on the drawings amount. The journal entry is capital account or debtor or drawings account data to interest on drawings account, because the drawings amount which is adjusted with the capital, so the capital account will be, the capital amount is reduced, so that should be capital account debited. Then interest charged by bank. So interest charged by bank, it is one of the expenses and the amount due to bank on this account is a liability. So interest charged by bank, this is one of the expenses and the amount due to bank. Here journal entry for this transaction is interest account data to bank account. Then next one is depreciation. Depreciation means reduction in the value of an asset. So that is the meaning of depreciation. The journal entry for depreciation is depreciation account data to asset account. Next we are going to see about what is bad debts. Not all debtors pay their dues every time. partially or fully irrecoverable debts are called bad debts. So, bad debts in the sense that amount is irrecoverable is called bad debts. Accounting and journal entry for recording bad debts involve two accounts. One is bad debts account and another one is debtors account. Recording bad debts, which involves two accounts. One is bad debts account and another one is debtors account, that is debtors name. Then bad debts account, bad debts is a loss for the business, that is a loss for the business, and it is transferred to the income statement to adjust against current period income. There are two methods to account for bad debts. One is direct return of write-off method and another one is allowance method. First one is direct write-off method in the sense when a receivable is considered not collectible, it is directly expensed in the income statement. The next one is allowance method. This is an estimate of the receivable made at the end of each fiscal year. These amounts are then accumulated in a provision account. The specific receivables are reduced every year by these amounts as per the requirements. So these are the two methods to account for bad debts. First one is direct write-off method and another one is allowance method. Direct write-off method, which receivable is not collectible but it is directly expensed with the income statement. Allowance method in the sense which is estimation of the receivable made at the end of each year. So this amount are accumulated in a provision, that is provision for bad and doubtful debts. So the specific receivables are reduced every year by these amounts as per the requirements. That is called allowance method. Then reasons for bad debts. When the debtors have a poor financial management, he cannot timely pay his debt. So debtors' inability or unwillingness to pay is one of the major reasons for the debts to become bad. When the creditors are not able to collect the debts due to some of other reasons. Also, when disputes arise regarding the price, quality, delivery, product, credit term, etc., the debts become bad. So these are reasons for arising the bad debts. The main reason is poor financial management. They cannot be able to pay the debt. And another reason is inability or unwillingness to pay is a major reason for the debts to become bad. Sometimes the creditors are not able to collect the debts. Another one is when disputes arises regarding the price, quality, delivery, product, credit term, so the debts become bad. So these are the different reasons for arising the bad debts. Then bad debts accounting. What is the meaning of bad debts accounting? Here bad debts form a part on the debit side in the income statement as an expenses. They are recorded in the year in which they become irrecoverable or when the debtor seem to not to pay the debt. Its second entry would be its deduction from the debtor in the balance sheet since they are now not recoverable, and hence the current assets would decrease, receiving lesser cash. Why bad debts matter? Since we are aware of the fact that not all debtors pay their part of the debt, we expect some debts to be irrecoverable. Also, we judge a company's performance on the basis of the financial statement. So we have already adjusted the bad debts in order to derive with an accurate financial position. bad debts recovery and its journal entry. How the bad debts recovered? What is the entry post for bad debts recovered? When the debts that were written off in the past year is now recovered either fully or partly is termed as bad debts recovery. It is usually an income. So this is recorded in the credit side of the income statement. For example, cash or bank account debtor to bad debts recovered account. Here the type of account, that is bank account, is relating to. Then bad debts recovered account is a nominal account, that is a income for us, so that account will be credited. Then what is the difference between bad debts and good debts? The opposite of bad debts is good debt. Good debt are those who are certain of the collection. When the customer are punctual enough to pay their debt timely, or the creditors are sure to receive the amount from debtors, that persons are called good debts. Here bad debts, sometimes a certain amount is not realized or partially on account of credit sales. The amount which are not realized is treated as bad debts. It is a loss which is to be debited. Bad debts recovered if the debt or an amount which is written off as bad debt is recovered later on. It becomes a gain for the business and is credited to a newly opened account called bad debts recovered account. Here the entry is cash account debtor to bad debts recovered account. Then loss of goods by fire or accident or theft. A business may suffer loss of goods on account of fire, theft or accident. It is a business loss and a nominal account. It also reduces the goods at cost price and increases the loss or expenses of the business. Here the journal entry for this transaction is loss by fire or theft account debtor, insurance company account debtor to purchase account.
Now we are going to see about how the transactions are journalized in the books of accounts. Here journalize the following transactions. January 1st, 2018, Mohan started business with cash rupees 80,000. January 6th, purchased goods from Ram on credit rupees 30,000. January 8th, sold goods on cash rupees 6,000. 15, bought furniture from Yash for cash rupees 8,000. January 18, paid salary to manager rupees 6,500. January 20th, paid rent to landlord in cash rupees 1,000. Here the first transaction is January 1st, Mohan started business with cash. So each transaction which affect two aspects. One is debit aspect and another one is credit aspect. Here Mohan started business with cash. So here what are the aspects here? Here cash account and another one is capital account. Here Mohan started the business. So cash account, here cash account and another one is capital account. Cash account and another one is Mohan capital account. So here cash is relating to real account. Here Mohan's capital is personal account. So cash account, what is the cash account is real account. What is the rule of real account? Real account is debit what comes in, credit what goes out. Here cash comes into the business. So here cash account will be debited and Mohan's capital account will be credited. Then the next transaction is January 6th. Purchase goods from Ram on credit. Here there are two aspects here. One is debit aspect and another one is credit aspect. Here what are the accounts involved here? One is purchase account and another one is Ram account. Purchase account and another one ROM account. Here purchase account is relating to real account, ROM account is relating to personal account. So purchase account is relating to real account. What is the rule of real account? Debit what comes in, credit what goes out. Here purchase goods comes into the business, so that account will be debited. Here ROM is a personal account. Here debit the receiver, credit the giver. Here ROM is a giver, so that account will be credited. So the journal entry is purchase account data to ROM account. Then another transaction is January 8, sold goods for cash. Here there are two accounts involved here. One is cash account and another one is sales account. So cash account is a real account, sales account is also real account, both are real account. Here the rule for real account is debit what comes in, credit what goes out. Here cash comes into the business, so that account will be debited. Then goods goes out of the business, so that account will be credited. So the journal entry for this transaction is cash account data to sales account. Then January 15, bought furniture from Yash for cash. Here cash, this is a cash transaction, so we have to consider only for cash, and another one is furniture. So here furniture and cash both are real account. Here furniture account is relating to real account, cash account is also a real account. So the rule for real account, furniture account debited, cash account will be credited. Because furniture comes into the business, so that account will be debited, cash goes out of the business, so that account will be credited. Then next one is January 18, paid salary to manager. So salary is one of the expenses which amount, this amount paid to the manager. So salary account is a nominal account. Indirectly here another one is cash, paid salary. So paid salary by way of cash. So cash account is a real account. So here the salary is a nominal account. Here debit all expenses and losses. So salary account will be debited. Then cash account is a real account. Here credit what goes out. So cash goes out of the business, so that account will be credited. So the journal entry for this transaction is salary account data to cash account. Then another one is January 20th, paid rent to landlord in cash. Here paid rent to landlord in cash. So rent account and another one is cash account. Rent account and another one cash account. Here rent is related to nominal account. Cash is relating to real account. Here rent is a nominal account. So debit all expenses and losses, credit all incomes and gains. So rent account will be debited. Here cash account will be credited. Here solution is first one, cash account data to Mohan's capital account, rupees 80,000. So debit is shortly called as DR. Then sixth one, purchase account data to ROM account. Here 6th January 2017, purchase account data to ROM account, rupees 30,000. Here being purchased on credit. So this is called narration. Narration in the sense it's nothing but explanation of the transaction. Already we have to record the transaction which is to be debited, which is to be credited. So we have to write the explanation of the transaction. It's called narration. Then 8th January, sold goods for cash. So what is the journal entry? Cash account data to sales account. So cash account data under this debit column rupees 6,000, and this credit column rupees 6,000. So cash account data to sales account. The narration for this transaction is being goods sold for cash. Then next January 15. January 15, furniture account data to cash account. Here furniture account data amount is 8,000. So 8,000 that should be recorded in the debit side, and cash account that should be credited. So to cash account that amount was recorded in the credit column. So the narration for this transaction is being bought furniture for cash. Then next transaction is 18th January, salary paid to manager. Here what is the journal entry? Salary account data to cash account. So salary account data, the amount column under this amount column 6,500, in cash column rupees 6,500. 500. Then next last one is rent paid to landlord. Here rent account data to cash account. Here amount is 1000 rupees, 1000 in cash in debit column and another 1000 rupees in credit column. So the narration for this transaction is being rent paid to landlord. The next problem is journalize the following transactions in the books of Ram Krishna. July 1st, 2007, Mr. Ram Krishna started business with cash rupees 2 lakh. July 4th, goods purchased in cash rupees 20,000. 5th, he deposited in bank rupees 40,000. July 7, goods sold rupees 15,000. 10th, goods purchased from Kamalesh on credit rupees 25,000. 11th, furniture purchased rupees 18,000. 12th July, wages paid rupees 4,000. July 20th, interest received rupees 500. July 25th, cash paid to Kamalesh rupees 25,000. July 30th, additional capital brought by Ram Krishna rupees 50,000. Similarly, the first transaction, Ram Krishna started business with cash. So what are the accounts involved here? First one is cash account and another one is Ram capital account, Ram Krishna capital account. So here cash account is relating to real account. Cash account is relating to real account. Ram Krishna account is relating to personal account because the Ram Krishna introduced the amount of capital, so that account is a personal account. So cash account, the rule, first we have to apply the rule for real account. Here debit what comes in, credit what goes out. Here cash comes into the business, so that account will be debited. So cash account debited, Ram Krishna capital account credited rupees 2 lakh. Then second transaction, July 4th, goods purchased in cash. Goods purchased in cash, so here there are two accounts involved here. One is purchase account and another one is cash account. Here cash account is relating to real account. Cash account is relating to real account. Purchase account is also real account. Purchase account also real account. So both are real account. You have to apply the rule for real account. Debit what comes in, credit what goes out. Here goods comes into the business, so that account will be debited. So the purchase account will be debited, cash account will be credited. So purchase account data to cash account. Then July 5th, he deposited in bank rupees 40,000. Here there are two accounts involved here. One is cash and another one is bank. Cash and bank. So cash is relating to real account. Cash is relating to real account. Bank is relating to personal account. Here cash he deposited in bank. So here who is the receiver here? Bank is the receiver. So the bank account will be debited. Here cash goes out of the business, so that account will be credited. Then next one is goods sold for cash. Here goods sold for cash, that is also here sales, cash sales. So there are two accounts involved here. One is cash account and another one is sales account. So cash account data to sales. Then next one is goods purchased from Kamalesh on credit. Here goods purchased from Kamalesh on credit. Here what are the accounts involved here? One is Kamalesh account and another one is purchase account. So Kamalesh account will be debited, purchase account will be credited for rupees 25,000. Then next furniture purchased. Furniture account data to cash account. Furniture account data to cash account. So furniture account will be debited, cash account will be credited, rupees 18,000. Next one is wages paid. Here wages account data to cash, rupees 4,000. Next one is interest received. Here interest received, that is the income for the business. So here what are the accounts involved here? One is cash account and another one is interest received account. Cash account and another one is interest received account. So cash account, cash comes into the business, so that account will be debited. Here interest received, that is the income. So that is relating to nominal account. Here credit all incomes and gains. So interest received is one of the income, so that account will be credited. Then next one is cash paid to Kamalesh. Cash paid to Kamalesh. Here cash paid to Kamalesh in the sense, here cash account and another one is Kamalesh account. Kamalesh account. Here cash paid to Kamalesh. Here Kamalesh is a personal account, cash is a real account. Here Kamalesh in the sense he is receiving the money. So that account will be debited. So here Kamalesh is a receiver, so that account will be debited, Kamalesh account for debtor. Cash goes out of the business, so cash account will be credited. The next last one is July 30th, additional capital brought by Ram Krishna. So Ram Krishna introduced the additional amount of capital rupees 50,000. Here what are the accounts involved here? Here generally the additional capital, he has introduced the additional capital. So the capital account and another one is cash account. So here cash account, cash comes into the business, so that account will be debited. Here capital, the amount of capital introduced by Ram Krishna. So the proprietor name is not recorded in the books of account. So we have to record the capital account. So journal entry is cash account data to capital account. So the solution for this transaction is first date July 1st, and this particular column first we have to write the debit aspect. So first one, Ram Krishna started business with cash, so you have to write that one, cash account debited rupees in amount column 2 lakh, then to capital account credit under this credit column rupees 2 lakh. The narration for this transaction is being start of business by Ram Krishna. Then next July 4th, purchase goods for cash. So here journal entry is purchase account data to cash account rupees 20,000. Then July 5th, cash paid into bank. So cash paid into bank in the sense, here bank is the receiver, cash goes out of the business. So bank account will be debited, cash account will be credited rupees 40,000. So the 40,000, the amount of 40,000 is recorded under the debit column and as well as the amount under the credit column. The narration for this transaction is cash paid into bank. Then next one is July 7th, cash account goods sold for cash. So goods sold for cash, here cash account data to sales account. So cash account data to sales account, here amount is 15,000 under debit column and 15,000 under credit column. The narration for this transaction is being sale of goods in cash. Then next transaction is July 10th. Here purchase account data to Kamalesh account. Here purchase account data rupees 25,000 to Kamalesh account rupees 25,000 in both the column. Then July 11th, cash purchase of furniture. So here there are two accounts involved here. One is purchase account and furniture account and another one is cash account. So furniture account is a real account, cash account is also a real account. So you have to apply the rule for real account, debit what comes in, credit what goes out. Here furniture comes into the business, so that account will be debited. Here cash goes out of the business, so that account will be credited. So the journal entry for this transaction is furniture account data to cash account. So rupees 18,000. So rupees 18,000 that should be recorded in debit column as well as in credit column. The narration for this transaction is cash purchase of furniture. Then next one is payment of wages in cash. Here payment of wages in cash, there are two accounts, one is wages account and another one is cash account. Here wages account is relating to nominal account, cash account is relating to real account. So you have to apply the rule for this account, wages account debit all expenses and losses. So wages account will be debited rupees 8,000 under debit column. Then cash goes out of the business, so that account will be credited rupees 8,000. So the narration for this transaction is being payment of wages in cash. Then next is July 20th. July 20th, cash account data to interest account, that is receipt of interest. So we are receiving the interest, so that is income for us. So interest account will be credited, that is relating to nominal account. So credit all incomes and gains. So interest account will be credited. Here cash comes into the business, so cash account will be debited. So the journal entry is cash account data to interest account rupees 500. So the narration for this transaction is being receipt of interest. Then July 25th, payment of credit purchases. Here payment of credit purchases, here Kamalesh, they are receiving the amount. So Kamalesh account data, cash goes out of the business, so cash account will be credited. So the narration for this transaction is being payment of credit purchases. So Kamalesh account data rupees 25,000 under debit column, then cash account rupees 25,000 under credit column. Then next last one is last transaction July 30th. Additional capital introduced by Ramakrishna. Here there are two accounts involved here. One is cash account and another one is capital account. Here cash comes into the business, so that account will be debited. Here capital introduced by Ramakrishna, so he is a giver, so that account will be credited rupees 50,000. So in both the column, cash account data in debit column 50,000 to capital account, then credit column 50,000. Then next problem is Chandran is a sole trader dealing in sports items. From the following transactions, past journal entries for the month of March 2018. March 1st commenced business with cash rupees 4 lakh. Second, cash deposited into bank rupees 3 lakh. Third, purchase goods from Ravi and payment made through net banking rupees 90,000. 4th March, sale made to Kumar, who deposited the money through CDM, cash deposit machine, rupees 10,000. 5th March, sales made to Vivek, who made the payment by debit card, rupees 60,000. 6th March, sold goods to Kirtana, who made the payment through credit card, rupees 50,000. 7th March, dividend directly received by bank, rupees 2,000. 8th, money withdrawn from ATM, rupees 3,000. 9th one, salaries paid through electronic clearing system, rupees 6,000. 10th March, cricket bats donated to a trust, rupees 10,000. So these are the various transactions in the month of March 2018. Here the first one, commence business with cash. So what are the accounts involved here? Okay, right, cash account and another one is capital account. Cash account and another one is capital account. So cash account is relating to real account. Capital account is a personal account. So cash comes into the business, so that account will be debited. Capital, which was provided by Chandran, so Chandran account will be credited. So the journal entry for this transaction, cash account data to Chandran's capital account, rupees 4 lakh. Then next transaction, cash pay deposited into bank. So what are the accounts involved here? One is cash and another one is bank. So cash deposited into bank. Bank is a receiver. Cash goes out of the business. So bank is relating to personal account. Bank is relating to personal account. Cash is relating to real account. So you have to apply the rule for personal and real account. Here debit the receiver, credit the giver. Here bank is a receiver, so bank account will be debited. Cash goes out of the business, so that account will be credited. Then next, purchase goods from Ravi, payment made through net banking. Here purchase goods from Ravi, but the amount paid through net banking. So this is a bank transaction. So what are the accounts involved here? One is purchase account and another one is bank, net banking, that is the transactions made through banking. So the transaction here we can take only purchase account and another one is bank account. Here purchase account is relating to real account, bank account is relating to personal account. So purchase, here we are receiving the goods, so debit what comes in case of real account. So purchase goods comes into the business, so that account will be debited. So the journal entry for this transaction is purchase account data 90,000 to bank account rupees 90,000. Then next one is sales made to Kumar, who deposited the money through cash deposit machine. So sales made to Kumar. You are selling the goods to Kumar. The money received through cash deposit machine. So we are receiving the amount through bank. So journal entry is bank account and another one is Kumar account. So bank account will be debited, Kumar account will be, so this is a cash transaction. So bank account will be debited and sales account will be credited because goods sold out of the business. So this is a real account, credit what goes out, so that account will be credited. So journal entry for this transaction is bank account data to sales account. Then next one is sales made to Vivek, who made the payment by debit card. This is also bank transaction. So sales made to Vivek. So we are selling the goods to Vivek. So he made the payment by debit card. So he paid the cash. So that is a cash or bank transaction. So the journal entry for this transaction is bank account data to sales account. Then next is sold goods to Kirtana, who made the payment through credit card. So they also pay the amount through credit card. So this is also cash transaction. So account, what are the accounts involved here? One is a bank account and another one is sales account. Bank and another one is sales. So bank account data to sales account. Then next one is dividend receipt, directly received by bank. So here what are the accounts involved here? Dividend account and another one is bank account. Here we are receiving the dividend. So that is the income for us. So that account will be credited. So this is a nominal account. Dividend is relating to nominal account. Bank is relating to personal account. Here on this personal account we are receiving the cash. So bank account data, dividend is one of the income. So that account will be credited. Then money withdrawn from ATM. Money withdrawn from ATM means that is a cash account data to bank. Then next salary is paid through ECS. So we have to pay the amount through bank. So salary account data to bank. Then cricket bats donated to a trust. That is the donation, we are giving the donation. So donation account data to cash, to purchase account. Donation account data to purchase account because the value of goods was reduced. So that account will be credited. Okay, now we can do the problem. In the books of Chandran, journal entries, you have to provide the date, particulars, ledger folio column, debit and credit. So the first transaction is March 1st, capital introduced by Chandran. Here narrate journal entry is cash account data to Chandran's capital account. So cash account debited rupees 4 lakh to Chandran account credited rupees 4 lakh. Okay. So the narration for this transaction is capital contributed by Chandran. The next transaction is cash deposited into bank. So cash deposited into bank, here bank account and another one is cash account. So bank is relating to personal account, cash is relating to real account. So bank account data to cash account rupees 3 lakh in both the column. Then next one is purchase account, goods purchased and payment made by net banking. So goods purchased, so purchase account data to bank account rupees 90,000 under the debit and credit column. Then next transaction is sales made and money received through cash deposit machine. Here there are two accounts involved here, one is bank account and another one is sales account. Here bank account is a personal account, so debit the receiver. So bank account will be debited rupees 10,000 under debit column. Sales account is a real account, so credit what goes out, here goods goes out of the business, so that account will be credited. Then next one is sales made and money credited through debit card. Here there are two accounts involved here, one is bank account and another one is sales account. Here bank account will be debited and sales account will be credited. So the amount is rupees 60,000 under both the column debit and credit column. The narration for this transaction is sales made and money credited through debit card. Then next one is sales made and money credited through credit card. Here there are two accounts involved here, one is bank account and another one is sales account. So here bank account is relating to personal account, so that account will be debited. Here goods sold out of the business, so that account will be credited. So bank account data to sales account rupees 50,000. Then dividend directly received by the bank. Here dividend is one of the income, so that account will be credited. Bank, we are receiving the amount through credit card, so that account will be debited. Bank account data to dividend account rupees 2000. Then cash withdrawn through ATM. Here the journal entry for this transaction is cash account data to bank account rupees 3000 in both the column. Then salaries paid through ECS. So salaries account data to bank account rupees 6000. Then credit back donated to a trust, donation account data to purchases rupees 10,000.
Thank you.
Welcome learners.